Balay ni Prutas. Balay ni Prutas, a statement of changes in equity. So, in the decrease and increase of the company shows that it has been increased by the total of 51,522,885,000 in the components of retained earnings minus from the other comprehensive loss from the previous year, because in the capital stock and additional paid in capital is 0% because of the amount of 2022 and 2023 is the same. So based on our horizontal analysis by components, the capital stock is as 0% because it means that the company did not issue any new share or buy back any existing shares during 2022 to 2023. Same goes to additional paid in capital. And in retained earnings increased by 108.52% because of the company retains more of its net income rather than distributing it as dividends to shareholders. And for the other comprehensive loss is decreased by 0.46%. This means that the company has not experienced a rise in unrealized losses from a certain financial activities. And for the vertical analysis, so the components are capital stock, so it decreases to 18.30% to 16.25% because there's a reduction in the value of the company's capital asset, such as machinery, buildings, or equipment over the specific period. And for the additional paid in capital, it also decreases from 70.21% to 62.35%. And for the returned earnings, it increased by 11.58% to 21.24%. It means that the company has generated more profit and decided to reinvest it back into the business rather than distributing it to shareholders. And for the other comprehensive loss, it decreases by 0.09% to 0.04%.
The price to earnings share of Balay ni Frutas Incorporation decreased from 1.79 in 2022 to 1.28 in 2023. This decline in the price to earnings share indicates that either the stock price decreased relative to earnings or the earnings increased significantly from 2022 to 2023. Balay ni Frutas Incorporation's diluted earnings per share increased significantly from 0.0279 in 2022 to 0.0392 in 2023. This suggests that Balay ni Frutas Incorporation has experienced a positive turnaround in the financial performance. This improvement could indicate a strong market position, effective management strategies, and positive growth prospect for the company. The increase in Balay ni Frutas Incorporation debt-to-equity ratio from 0.10 in 2022 to 0.22 in 2023. This suggests that the company took on more debt during 2023. This due to several factors such as expansion, investment, and financial distress. In 2022, Balay ni Frutas Incorporation achieved a return on equity of 0.09, indicating that the company generated 0.09 in profit for every peso of shareholders' equity invested. In 2023, Balay ni Frutas Incorporation return on equity increased to 0.18. This means that in 2023, the company generated 0.13 in profit for every peso of shareholders' equity. The increase in return on equity indicates improved profitability and efficiency in utilizing shareholders' equity to generate returns. Balay ni Frutas Incorporation's equity to asset ratio decreased from 0.90 in 2022 to 0.82 in 2023. This indicates a slight shift in the company's capital structures with a lower proportion of assets being financed by equity.
The findings of the Statement of Changes in Equity. For the capital stocks of both year 2022 and 2023, its range of the change at the 74,750,250, and the additional paid in the capital is also remained constant in 286,843,181 pesos. So this implies that the company did not receive or issue new shares or receive investment in the year of 2023. It suggests that the company equity in structure remains stable regarding to the new equity of the graphical info. For the return earnings is a double increase from 47,315,510 to 98,662,184 in the year of 2023. This substantial increase indicates strong during the year of 2023. And for the other comprehensive losses is decreased from 375,566 to 200,155 in the year of 2023, so that the company managed to induce losses from the comprehensive income sources. This might be factors such as the realized gain or the losses of the company. And for the ratios is some other ratios is in the year of the 2023 is decreases and increase for the other ratios. And the year of 2022, some other ratios is increased than the year of 2023. So the company's overall financial information is reduction of the equity.
In the capital stack, there is no addition, and for the paid-in capital, there is no changes. So it indicates the company did not seek new equity investments or issue new shares. So this stability suggests a mature equity structure without the need for external financing during the period. And the significant growth in retained earnings highlights the company's robust profit generation in 2023. The company chose to reinvest these profits back into the business rather than distributing them as dividends, which could signal confidence in future growth opportunities. And the reduction in other comprehensive loss indicates that the company is effectively managing its non-operational financial risks, such as foreign exchange or other factors affecting its comprehensive income. This improvement enhances the overall equity position. The overall increase in total equity by 51.5 million reflects the company's strengthened financial standing, driven primarily by retained earnings. This growth indicates a solid financial position and could make the company more attractive to investors. And the combination of increased retained earnings and reduced comprehensive losses suggests that the company is managing both its operational profitability and non-operational risks effectively. This implies that management is making prudent decisions to ensure the long-term financial health of the company. And for the findings, given the significant increase in retained earnings, the company may consider distributing a portion of these profits as dividends to the shareholders. This could enhance shareholder satisfaction and attract further investment, especially if the company has sufficient capital for its growth needs. And if the company sees potential for expansion, reinvesting the retained earnings into business operations or market expansion can be a strategic move, while leveraging these funds to diversify product lines or enter new markets could further increase profitability in the coming years. While the company has not raised new equity, it could consider a low-cost debt financing if it plans to expand. With its strong financial position, the company could access favorable interest rates, allowing it to grow without diluting ownership or issuing new ships. Though the company reduced its other comprehensive loss, further action could be taken to mitigate risks in this area, exploring hedging strategies or reducing exposure to factors like foreign exchange fluctuations or pension liabilities could strengthen the company's balance sheet further. Given the improvements of financial performance, the company should ensure a clear communication with stakeholders through its financial reporting. Enhance transparency about how retained earnings are being used or future growth plans can foster investor confidence. And lastly, a strong growth retained earnings indicate successful and profitability strategies. The company should continue to focus on efficiency, cost management, and innovation to sustain or grow profits in the coming years. Maintaining this trend will further solidify the company's financial health. So in the overall recommendation, the company is in a strong financial position with a solid profitability and a growing equity base. Management should evaluate the best use of retained earnings, whether through investment, debt financing, or shareholder returns, to ensure sustained growth and shareholder value.